Diwali is round the corner. This is one festival where people celebrate money and financial prosperity in the form of Goddess Lakshmi. On the day of Dhanteras, people usually buy gold in the form of coins or jewelry. Early civilizations equated gold with gods and rulers. Most humans intuitively placed very high value on gold, equating it with power, beauty, and the cultural elite. Indians consider gold to be auspicious and hence they buy it around festivals like Diwali. And the purchase of gold jewelry is seen as consumption in the form of ornaments as well as an investment which appreciates in value over time. If we look at the consumption pattern today, almost half of the gold in the world is used in the form of jewelry. Next 24% is used as investments in the form of ETFs, gold mutual funds and coins. Next 23% is held by central banks around the world in the form of gold reserves, and the rest is used in smartphones, calculators and other electronic devices and even in tooth fillings. This brings us to the question that why you should invest in gold. If you look at the price of the gold over the last 30 years, it has given a decent CAGR of over 9%. Moreover, gold price and stock markets show an inverse correlation which makes it a natural hedge against your equity portfolio while you do your asset allocation. So, you should have at least some amount of gold in your entire investment portfolio. The bigger question which remains is how one should invest in gold. The traditional way of buying gold is a physical form of jewelry, coins or bars. But there are other options available now if you wish to invest in gold electronically, such as gold ETFs, mutual funds, sovereign gold bonds and digital gold. Let's look at each of these and try to find out which one fares better simply from the perspective of investment. We will now look at the factors which we should consider when buying gold for investment. We will also see how these factors fare for each of these 5 options. Gold has always been a subject people are inquisitive about. So I am sure you will have some takeaways from this video. Number 1, ease of buying. Physical gold can easily be bought in the form of coins from banks or jewelry stores. Banks sell gold of highest purity, that is 24 karat or 999.9 purity. They also offer discounts to persons who buy gold in bulk. Alternatively, you can buy gold coins from jewelry shops. You can also buy gold in the form of jewelry from your nearest jewelry store. On the other hand, digital gold is sold by many fintech companies and is available on their mobile apps. Same applies to gold mutual funds and ETFs, and they can be bought on trading platforms or mutual fund websites. When it comes to sovereign gold bonds, it becomes a little tricky. They are sold by RBI in tranches and are available in the primary market in time-bound manner. Each tranche, wherever available, is open for 5 working days from Monday to Friday. However, if you miss any of these tranches, you can come back to the secondary market and buy any tranche of SBG here. You can do this on any of the trading platforms electronically. Number 2, risk. Physical gold is always risky. It is prone to theft, needs to be stored carefully, which adds to the cost of simply owning it. Though banks sell gold of highest quality, the quality of gold sold by your local jeweler can be compromised. Gold ornaments are subject to wear and tear, and some gold can be lost in the making process or while you are trying to exchange your old jewelry. Number 3, minimum investment amount. Physical gold is usually sold in the form of jewelry or coins, and in most places coins start from half a gram. So the minimum investment amount would be the value of half a gram of gold plus making charges plus a GST of 3%. In current prices, this would come to around 3,500 rupees. When it comes to buying digital gold, you can buy it for as low as rupee 1. In this sense, buying digital gold is extremely convenient. In case of ETFs, you have to buy a minimum of 1 unit, which is 0.01 grams. So this again comes to a very low amount, which is around rupees 60 worth of gold. On the other hand, most mutual funds have an entry amount of rupees 100 or 500, which is also not very high. But in the case of sovereign gold bonds, you need to buy units which are of 1 gram each. So each unit of SGB will cost you around rupees 6,100 at current prices. The fact is that gold is available at rather low quantities and amounts, which makes it accessible to all kinds of investors. Number 4. Costs. Buying gold in any form comes with some costs which are charges over and above the value of the gold. Hence, some options look more attractive than others purely on the basis of returns they offer. Physical gold in the form of ornaments or coins comes with various costs. Making charges on jewelry can cost you anywhere between 10 to 20% of the value of the gold. On top of that, you have to pay GST of 3% on gold value and 5% on making charges. Additionally, you have to spend on bank lockers to store the gold. So if you hold this gold over a period of 10 years where it gives you a return of around 9%, the actual return earned by you considering all these costs is less than 5%. So this makes it a less attractive investment option simply from the point of view of returns. Now digital gold also attracts a GST of 3% on gold value. If you look on the face of it, it does not come with any other charges. But if you look deeper, it comes with a very high buy-sell spread. This simply means that you buy at a price which is much higher than the sell price at the same time. Now at the time of recording this video, on one of the digital gold platforms, the buy price of digital gold per gram is rupees 6259.90. But at the same time, its selling price is 6055.93, which makes it a spread of around rupees 203.97. This spread is 3.25% on the cost of buying. This spread charged by digital gold platforms is justified because they have various costs and of course a profit margin for them. Gold ETFs usually have an expense ratio ranging from 0.5 to 0.7%. In addition to these, they have smaller costs such as brokerage charges, demat costs, STT and stamp duty. On the other hand, gold mutual funds have an expense ratio in the range of 0.1% to 0.2%. This looks very small, but when we add the cost of underlying assets, which are gold ETFs, a different picture emerges. So the combined expense ratio of gold mutual funds comes in the range of 0.6 to 0.9%, which is again not very small. Now sovereign gold bonds are quite popular in India and they have raked in an amount of 43,000 crores for the government. There are no visible costs attached to buying and selling SGBs, and if you buy them digitally, you get an extra discount of rupees 50 per gram. Along with this, SGBs offer an extra return in the form of interest rate, which is 2.5% per annum on initial investment amount. This interest rate is over and above the return earned by gold and is credited into your bank account semi-annually. No other form of gold investment offers such returns, and this makes SGBs unique. If we simply look at returns, SGBs offer a return of 11.5%. If we consider the return on gold to be 9% and add an extra interest rate of 2.5%, which it gives additionally. Gold ETFs come next if we deduct an expense ratio of 0.6%, which brings them to the return of 8.4% annually. Gold mutual funds are a tad bit lower when we account for an extra expense ratio of 0.2%. This makes them to offer a return of around 8.2% annually. Digital gold comes with a higher cost in the form of a spread. On this account, the returns offered by digital gold on an annual basis range somewhere between 7.5 to 8%. Sovereign gold bonds here clearly win the race, but let's not declare them a winner yet because there are other factors to be compared such as liquidity and taxes. Number 5, liquidity. Coming to liquidity of gold investments, it is a very important factor. People in India see gold as an asset which they can resort to if money is needed immediately in the family in case of any emergency. And rightly so, liquidity is not a problem in most of these investment options. If you have gold ornaments or coins, you can sell them almost within a day to your local jeweler and get the money. Gold ETFs and mutual funds can be sold on any of the trading platforms during market hours. However, the money will hit your bank account after 2 days. Digital gold can be sold practically anytime electronically, which makes it a highly liquid investment option. Sovereign gold bonds come with a fixed tenure of 8 years. However, as an investor, you have an option to redeem your investments anytime after 5 years at the prevailing market prices. If you wish to redeem your bond before that, you have an option to sell them the demat form in secondary market 6 months after issuance. But these bonds are usually sold at a discount in the secondary market due to lack of liquidity. This is good for you if you are a buyer, but not good for you if you are a seller. This makes it the least liquid of all the above options. But if you wish to invest in these bonds through secondary markets because they are available at a discount, you can analyze the discounts available on various tranches and make a good decision for yourself. I personally don't like this feature of fixed tenure because we have to mandatorily redeem these bonds once the tenure is over, even if at that time the gold price is having a rough patch. But this is how these bonds function and we cannot do much about it. Number 6, taxes. The last thing to check is how all these investment options are taxed because it impacts the actual returns you earn on your investments post taxes. As we have discussed earlier, you have to pay a GST of 3% when you buy physical or digital gold. ETFs incur a GST on transaction costs such as brokerage and STT. On gold mutual funds and SGBs, you visibly have no taxes when you are buying them. At the time of redemption, however, different instruments are taxed differently. On physical and digital gold, there is a capital gains tax which depends on your holding period. If you hold your investments for less than 3 years, you have to pay a capital gains tax based on the marginal income tax rate. However, if you hold your investment for 3 years or more, you have to pay a capital gains tax at 20% with indexation benefits. In case of gold ETFs and mutual funds, there is no concept of holding period and you have to pay tax based on your marginal tax rate. This means that you have to pay the tax based on the tax slab rate applicable to you. Coming to sovereign gold bonds, the interest rate of 2.5% which you earn annually is added to your annual income and hence it is taxed at the slab rate applicable to you. If you redeem the bond at the end of 8 years at maturity, the capital gains earned by you are completely tax-free. This again makes SGB an attractive investment option. However, there is some confusion on how your capital gains will be taxed if you redeem your SGBs prematurely between 5 to 8 years. I am not a tax expert or tax consultant, so please discuss all these tax implications with your tax consultant before making your investment decision. This brings us to the end of this video as we have discussed all aspects of these gold investment options. Remember that physical gold has its own charm. It is consumed as jewelry by women in most of the Indian households. Buying gold in any other form has its own benefits, but these are solely for the purpose of investments. So weigh all these options and make your decision on the basis of what you want to do with the gold you purchase this Diwali season. If you are still watching this video, I hope you find some value in it. If you have any queries related to the content in this video, please let us know in the comment section below. If you found this video useful, don't forget to like, share and subscribe to this channel. A very happy Diwali to all of you and I hope you have a great time.